Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. This video is for Friday, March 23, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And it was a pretty big down day once again for the S&P or the SPY across the board. All markets were down pretty substantially. We'll get to the other markets in a moment, but you had the Dow that was down about 425 points, the S&P 500 down 55, NASDAQ Composite down a whopping 174 points, or 2.4%, leading all the markets to the downside. Let's talk a little bit about the support area that we came into on Friday. We talked about the fact that if the 261.66 area did not hold on a daily chart closing basis, then we would go to the 200 period moving average. That was the next logical area of support. We actually did it all in one day. And just to kind of take you through an intraday analysis of what happened, you can see here that the market consolidated above the 261.66. First, we got below the 264.82. That was the prior trading day. Then early on Friday, we began to consolidate right underneath that 264.82. Looked like a few times the market was making an attempt to get back above that level. What was once support becomes resistance. That level was rejected, and the market went down, or the spider went down to the next level of 261.66. Interestingly enough, intraday, we came up about 10 cents short. The low was 261.76, 10 cents short, or one S&P point short of that target support level. The market pretty much had a decent rally off that level, but then later in the afternoon session, we came down to bust through that level and close right around the 200 period moving average. Going back to, well, before we go back to the daily chart, to just show you something that's important to note. This applies to any chart and all charts, all time frames. Here's a consolidation area. You can see what happened when the market rallied back up to retest that consolidation area. That's where the market failed and rolled over once again to make new lows. In order for the market to turn at least short-term intraday bullish, we would have had to get really back above that 264.82, give or take, 10 or 20, 25 cents in the spider. We would have had to get back above that consolidation area. The market was unable to do that, and then we just rolled over and fell into the rest of the day. Now, why is that important? It's important because when we finish on the lows, specifically on a Friday, but really any day, that really portends more downside coming the following trading day. Now, it may not happen right out of the gate on Monday. However, there should be more downside coming in this market. Finishing on the lows for the week, finishing on the lows for the day on Friday should mean more downside coming sooner than later. Now, all that's well and good, but the $100,000 or maybe $64,000 question is, where do we go from here? Where is the bottom in this market? Where is the buying opportunity? And this is what's important. There is a buying opportunity ahead of us. The question is, when and at what price is the buying opportunity? In terms of stocks, we can really use the major market. We can use the S&P 500 as an indicator of when that index or when this index bottoms. That's when you'll see a lot of these stocks that are short-term oversold. You'll begin to see them make a turn. You'll begin to see them put in signals of a trend change or a reversal, and you'll begin to see them rally. And there are big gains to be had if you can select the bottom close enough. You don't have to be on the minute. You don't have to be on the exact price of the bottom. You have to be in the general vicinity. We're never going to pick the bottom 100% of the time in a situation like this. However, there is a bottom close at hand, and if we can pick the bottom close enough, that will mean large gains ahead for many, many stocks across the markets. And not just stocks, but we can also buy the index. We can buy the S&P, we can buy the IWM or the Russell 2000, which we'll get to in a minute. We can buy the NASDAQ Composite, you can buy the Dow, you can buy the what's called the diamonds, which is the exchange traded fund that tracks the Dow, it's not going to matter because the entire market will turn together when we do pick a bottom. In my experience, the best indicator of a bottom across all the markets will be the IWM that will usually lead the market both in the up and the downside direction. And we'll get to the IWM next, but let's see if we can identify where the likely bottom is for the S&P or the spider. So we're looking right now at the market that actually closed, and this is another indicator of more downside in my opinion. We closed slightly below where the 200 period moving average was. The 200 period moving average came in at 258.24 on Friday, and we closed slightly below that, 258.05. I take that as slightly negative, but not as important as the fact that we closed near or on the lows on Friday at the end of the week. That is more negative than the slight 20-cent close below the 200 period moving average. So the next logical area of support really is this double bottom area. This comes in at 252.92. That's the next logical area. However, markets have a funny way of tricking and fooling as many traders as they can, as many investors as they can, as much of the time as possible. So my theory on this market right here, right now is that we don't necessarily, while we might intraday, even might for a day, 2 or 3, we might find support at double bottom, 252.92, give or take. However, I don't think that's where the ultimate bottom becomes in this market. And when I say ultimate bottom, I mean on this move. This is now getting into an oversold condition. Markets can stay oversold for a lot longer, and overbought for that matter, a lot longer than most people think they can, and most people can stay solvent if they're on the wrong side of that. So you don't want to be on the wrong side. There's no point in jumping in early ahead of a trend change signal. We're looking for signals of a trend change. We're looking for either a high volume reversal, we're looking for a reversal candle, we're looking for a doji candle or a pseudo doji candle at the right time. And these are the things that I discuss in my course at lazyminitrader.com. How to identify bottoms, how to identify tops with a high degree of certainty and a high degree of probability. Now first, I want to show you why my theory is that double bottom down at 252.92, where we just had the black line down here, you can see the low 252.92. Why that's not necessarily, in my opinion, going to be the bottom before we get a substantial bounce and a substantial snapback of this market. In order to do that, in order to display to you why I think that is the case, I'm going to go over to the S&P E-mini futures contract. We're looking now at the June contract. And what you'll see is when we made this bottom, that was on the 6th of February, we made a double bottom low just a few days later on the 9th of February. That did not show up on the SPY chart. Why is that? Because this happened in the overnight session. By the time the market opened up the following day, the market was rallying and then went substantially higher. The reason I'm pointing this out is because, in theory, when you look at the futures market, we've already tested that double bottom low. I don't expect this low to hold yet again. Now, while we may hold from a daily chart closing basis these lows, I do think that we go lower intraday. I think we go at least all the way down to 2,500. That's a big fat round number. And you also have an important consolidation and a breakout point right here. Markets love to come back and test former breakout and breakdown areas. You've heard me say that, if not hundreds, dozens and dozens of times. I expect this time to be not a lot different. Now, how do we translate that back over to the spider? Where do we start looking for signals and signs of a bottom in this market? Well, you look over here to the left and you see that this consolidation area comes in right around 249, 250, in that neighborhood. Okay, you can see here, that's the same breakout area that we just looked at in the S&P E-mini futures contract. So there's your consolidation area, and if you just draw a straight line over from where this breakout occurred, generally speaking, well, it's actually a little bit lower. The way the numbers work out, it should take us down to around the 250 even number. Again, that corresponds with the 2,500 on the S&P E-mini futures contract. So we may have around another 70 to 80 S&P handles on the downside yet in front of us. Now, we're not going to try and pick the bottom. We don't have to be the first ones to the party, but we do want to be at the party while everybody's having fun. So what we're going to do is, if and when the S&P or SPY starts to approach near that 250 mark, that's when we're going to be looking for signals of a reversal. We may see it intraday. We may see it on the hourly chart. We may see it on the daily chart. We may see a gap down and a recovery and finish on the highs of the day. That'll be a reversal. We may see a signal of a trend change, such as a pseudo doji or doji candle. These are going to be important things to watch out for, but I'm really going to start looking very, very closely for these to occur when we get to around that 250 area. We may have another couple of days of downside. We may go sideways for a few days and have another leg lower. You just don't know exactly how it's going to work out, but that's why we analyze the markets each and every day, because each and every day we get more and more information about what the charts are telling us. The charts are always giving us information. Our job as analysts and our job as traders and investors are to decipher what the charts are telling us and go with the highest probability scenario that we believe the charts are telling us. Right now, I don't think we're at a bottom. I think there's lower prices. I will be looking closely for signals of a trend change when we go slightly lower, namely when we break these lows from February. That's where I'm going to begin looking. And the low is 252.92. So it's not that far off from the 250 that I'm looking for, but I still think we spike through that a little bit to try and fake out as many traders and investors as possible before putting in signals of a trend change or a market reversal. So that's what I have my eye on. That's what I'm looking for in the days coming ahead. Remember, we're in a very oversold short-term condition right now. It can stay that way for a while, but you know what's going to happen. The longer or farther we get away from home base. Home base is the 20-period moving average. Look how far away we are all of a sudden from home base in just 2 trading days, Thursday and Friday. Look how far away we got from home base. We're not going to stay far away from home base for that long of a period of time. We're going to end up seeing the market snap back toward home base, or at least go sideways and have home base turn down into price or come down into price before this market is ready either for another leg lower or a snapback toward home base. And keep in mind, the farther we get away from home base, the more violent the snapback becomes. When we enter these type of high volatile markets, the large swings in both directions become very, very pronounced. In just 2 trading days, the S&P was down about 100 points. If the market does what I think it's going to do and comes all the way down to around this area, okay, maybe it's 248, 247, 251, 250, in that neighborhood. We don't have to know the exact number right now. What we have to do is look for signals that the market will give us that it's making a turn, and it will give us the signals it always does. But when and if we do get down there, you will see a violent snapback where the market can actually recover 40, 50, 60, 70 S&P handles in 2 or 3 days in a flash. That's going to mean substantial rally for a lot of stocks across the market. It's going to mean a substantial rally for the Dow, the S&P, the IWM or the Russell 2000, the NASDAQ, all across the board. Everything will rise together. A rising tide lifts all boats. But just be careful trying to pick a bottom before the time is right. The market will give the signal. And by the way, when it does, we'll talk about it right here in these videos. The IWM, the Russell 2000 index, you can see here that we really fell hard and fast the last couple of trading sessions. Interestingly enough, look where the high of the day Friday was. Right up against that upsloping trend line that comes over from the long-term chart. We're below that line. I'm keeping that in the back of my mind until we get toward the latter part of March, which is coming up pretty close. So once we get to the end of March and we close business for March, it's going to be interesting to see where we are relative to that line. Are we trading and closing below that line for the month of March? Are we trading and closing above that line for the month of March? It's going to be very, very interesting because that may be either a failed breakout or a quick recovery by the end of the month. We'll see. I'm not going to project what's going to happen. We're just going to watch very closely because that'll give us an indication of what's to come following the close of business of March. Now, another interesting factoid, when you look at the S&P against the IWM on the daily chart, they do look slightly different, and I'm calling for different lows to be made relative to each of these indexes. So right here, if we come down and pierce through or spike through the 200 period moving average, I would expect the IWM to find support right around this 147. I have it at 146.95 area. Now that's slightly different look than the SPY. We'll just flip back to the S&P 500 or the SPY. I'm looking for 250.32 is actually my number from a mathematical perspective. That's where I expect the S&P or the SPY to come down to, at least from an intraday perspective. Closing below this level would be somewhat ominous for the SPY, but I think we can get down here, at least from an intraday perspective, hit that level, and I'm going to really be looking for signals of a trend change in and around that area. Back to the IWM though, you can see here that I'm not expecting a spike through the lows from February 9th in the IWM. I'm expecting the IWM to find support at the 146.95. We'll see how it works out. It's really not that far away from where we are now. So if we do sell Monday and Tuesday, for example, we may find bottom rather close to where we are today rather quickly, but we're still waiting for signals of a trend change. If we begin closing below 146.95, 147, that's going to really bring double bottom into play, and that comes down to a low of 142.50. So that's what I'm looking for in the IWM. The transports. Remember the transports. We talked about this bearish pattern that was inside of a bullish pattern. Which one was going to win out? We could have been consolidating underneath the 50 period moving average to make a run higher, build some energy for another push higher. That didn't happen. This bearish pattern ended up playing out to the downside. Once we closed below, right, and we talked about this on Thursday when it happened, once we closed below that low from that green up candle, then that was very bearish for the market. We had another potential here, but that didn't hold. And then the market, once it got below the 100 period moving average on Thursday and closed below there, we brought double bottom into play. And where did we come on Friday? Double bottom almost to the penny. We'll see where the transports decide to find low, whether it's going to be at the 200 period moving average, just below 10,000, or down at double bottom at 9,800 and change. It's not that much of a difference. So we'll call it around double bottom, potentially even a spike through, but I don't think by that much. And I would find it a little bit interesting if we closed below double bottom on a daily chart closing basis. I don't know that it's just ready for that yet, but if we do, there's another safety net down here. And again, I'm making light of the fact that these are hundreds of points, but this is around 94 and a quarter, 94.50 down here, and this is about 98 and a quarter or so. In fact, let's get the exact number of where that double bottom is. That double bottom is 98.06, spot 79. So that's where I really think we should find some daily chart support at double bottom. If we close below that, then we bring this bottom into play, and that really comes in at a low of 94.20. So there are hundreds of points in between these areas, and that's very, very bad for the markets. That would mean a lot of downside for other major market indexes. However, right now, I think we have our eyes set, or I have my eyes set on the double bottom in the transports from the February lows. Gold market, what do you know? Look what happened on Friday in the gold market. We finally had a spike higher as the market, the stock market, was selling off. And where did we close above? We closed above the high that we talked about that was extremely important to close above to see more upside in this market. Here's the range we were in, and this market wasn't going to find a really longer-term directional move until we broke out of this range. We broke out of that range on Friday. We may come down to backtest that, but I expect the market, at least in the short term, to stay above this range, and I think we can get up to this double top up here right around 1370, and we could potentially go higher. We could potentially run a lot higher if this market wants to really rally. We've consolidated for a very long time in this range right here, in this trading range for a while. The market, the gold market, has a lot of pent-up energy from this trading range that we spent quite a bit of time in. This energy is now being released, at least from what looks like right now, to the upside, and we will find resistance at these double top, these pivot top areas. That's common and normal market behavior. Okay, there's your pivot tops. 1, 2, 3. But if we can get above this pivot top here, then we can probably run up to 1400, maybe slightly above 1400 in the gold market. That's a little premature. Right now, let's see a couple of consecutive closes above that important pivot high. That high came in at 1342. We're above that level. We're trading above that level. As long as we stay on the daily chart, closing above 1342, this is essentially turned bullish. We're above all the moving averages. That's bullish for the market. There are normally, or under normal conditions, I should say, higher prices are coming in the gold market. But we really had to wait for us to break out of that trading range before any clarity came in one direction or another. Could have made a case either way for upside or downside in the gold market. We made several cases on the downside that we were consolidating over the 100 period moving average, but never once did I say it's a clear directional, it's a clear signal to the downside. We just never had it, and look what happened. We tried to rally a couple of days ago, we failed. We came up into the 50 period moving average, failed, and we finally broke out on Friday, and that's a positive sign for the gold market. We'll see what happens in the coming days. Bullish gold right here, right now. Crude oil, remember the important weekly close, 65.29. Where did we close the week? We closed the week, this is Friday's close, at 65.88. That's bullish. We will have resistance up in this area at these pivot tops up here, namely right up here that comes in at 66.55. Get above that, and we really start to get into play the number that I've been talking about for quite some time, and I'll go over to the weekly chart. In fact, we don't need this anymore. We already did that close. Go over to the weekly chart, and you'll see where my next target is. My next target is 73.78. Remember the 200 period moving average. You can see how the 200 period moving average is sloping in towards price, and you can see how we really consolidated underneath that level for enough time where I don't think this 200 period moving average is going to be much resistance. It's a weekly chart 200 period moving average, but it shouldn't be much resistance. All we really have to do is get above 66.17, and we have that high that we just looked at, 66.55. We get above 66.55 and begin closing daily, and then certainly a Friday or weekly close above that level, and we get into play some of these higher levels. Here's another pivot up here, 68.86. That's another area that will be formidable, resistance for the crude oil market. Ultimately, my target is 73.78. If we can get up there, I think that level will represent, depends on how we get there and what the market looks like when we get there. But right from now, the math tells me that that level should be a stone cold short. I've got my eye closely on the crude oil market. And with that, folks, it's everything I wanted to and intended to discuss today. Therefore, I'm going to leave it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.